Welcome then to our November Geography Matters. This is our final Geography Matters for 2024. Been a fantastic series, and I think we've got a brilliant group of speakers lined up for you tonight, where we'll be hearing from Vanessa Beenders and Emma Vitz, together with interviewer Chris Zinn, who'll be discussing insights into the complex relationship between climate change, extreme weather events, and the insurance industry here in Australia. Before we get rolling, I would like to acknowledge the traditional custodians of the lands on which we are all meeting tonight, and pay my respects to elders past, present, and emerging. For myself here in Brisbane, that's the Yagara and Turrbal peoples, and I know we're joined by many from across Queensland and Australia tonight. Quick plug, as always, for some upcoming RGSQ events. We do have our final Geography in Conversation for the year coming up on the 26th of November, looking at the Toondah wetlands, reflections on the outcome. Likewise, then in the first week of December, we have the Map Group Show and Tell, always a great event to go along to. And to wrap out the year, we do have the RGSQ Christmas party on the 3rd of December this year. Please do check the RGSQ website. Details I've just thrown into the chat if you want to register for any of those events, and to keep an eye on our event list for 2025 coming out very soon. Tonight, though, we will be hearing from a brilliant range of speakers. Our first presenter is Vanessa Beenders, who's the Executive General Manager for Public Policy and Professionalism with the Actuaries Institute of Australia. Vanessa leads the Actuaries Institute's Thought Leadership Program, working closely with actuaries across a wide range of areas to deliver insights on key societal issues in major reports, papers, and submissions. She's also responsible for delivery of the Institute's support to its practice committees, providing technical and professional support to its members. Before joining, Vanessa worked across government, financial services, and education in consultant with Finity. She advises insurers and banks on personal lines pricing, natural perils, and climate risk assessments. Emma compiles the Australian Actuaries Climate Index on a quarterly basis, which quantifies the changes in the frequency of extreme weather events in Australia. She coordinates communication on the index with a variety of audiences, including the actuarial community and the wider public. Finally, our interviewer tonight is Chris Zinn. Chris has a Masters of Geography from Hertford College, Oxford, and the experience has been significant in his career as a journalist here and overseas across newspapers, radio, and TV. He has specialised in environmental and societal stories, and run campaigns and communications at Choice for some years, and is vested in forging better consumer outcomes. His experience with boards and councils of various associations and not-for-profits is included as Chair, Director or CEO of Eastside FM Community Radio, KidSafe Australia, School Food Project New South Wales, Cemeteries and Crematoria New South Wales, Life Sherpa, Private Health Insurance Intermediaries Association, and now a councillor with RGSQ. Without further ado, though, I will throw over to Vanessa and Emma. Please take it away.
So it is, and the next one, please, Emma. It's always a pleasure to hear who takes interest in the Actuaries Institute work, so thank you for inviting us to this session. I will cover the report which was published by the Institute in August this year called Home Insurance Affordability and Home Loans at Risk. The next slide, please, Emma. So first, a little bit about the Actuaries Institute. We are the professional body for actuaries in Australia. We have got about 5,600 members. They come together in their professional capacity, and our work is guided by the public policy principles which are shown in the bottom left-hand corner of the slide there. I want to make absolutely clear that we are not an industry group or a lobby group. It is very much about improving public wellbeing, the work that the Institute does. So shown on this page is a series of thought leadership papers that the Institute has published since 2020 on the topic of home insurance affordability. And that was well before it was a major cost of living issue, and it was driven by our members' concern that even then the changing climate will place upward pressure on premiums and make insurance less affordable and available. Now, because insurance is an important part of resilience, ensuring it remains available and affordable is something that absolutely matters to society, is what we recognise. Next slide, please, Emma. So now specifically on the report which we published in August this year, the key finding, the headline finding from that is that as at March 2024, which is when the data was taken from, we estimate that 1.61 million households, or that is 15% of Australian households, face what we call affordability stress. And that is defined as that they face quotes for, or new premium quotes for their home and contents insurance policy that exceeds the equivalent of 4 weeks of gross household income for them. At such a level, we consider that a very significant expense and something that many households would likely not purchase, which is why we have defined it as the point of affordability stress. So in this way, the indicator is also a proxy, if you like, or an indicator for non-insurance. So on the left-hand side of the slide here, the graph there, it is the red shaded area, which shows that insurance, the stressed population is now 15%. On the horizontal axis is the distribution of the population by the percentile of the home insurance affordability for each specific household. So from least expensive at the 0% point to the most expensive at the upper end of that horizontal axis. And on the vertical axis is then what it equates to in the weeks of gross household income that it costs to pay the insurance premium for that household. So what we see, or through the series of reports that we have done for 3 years now, is that home insurance affordability stress has increased from, it was 10% in 2022. In 2023, it increased to 12%. And this year, as I said, it had increased our estimate to 15%. The increases have been consistently because the increases in home insurance premiums have exceeded the increases in household incomes. And that is shown by the chart on the right-hand side at the in the top space there, where blue shows what the distribution of incomes this year, and the grey then is the previous year's income, how it has changed. What we show in the right-hand side in the bottom graph is how the premium increases have been strongest, or the decreased affordability pressure has been felt most acutely by the households who face the highest risk. So that is showing that that bottom chart shows how income has grown over the 2 years. Just a few technical points about this slide. The first thing is that affordability and availability at some point we realise become the same concept, because when insurance becomes unaffordable, in practice it is unavailable. The index here, though, we acknowledge is a theoretical measure, so it is not actual premiums paid by people. It is based on a very large sample size of 10,000 quotes that are taken for new business policies from a range of insurers. It's a market representative portfolio which is surveyed. The second point is we do make the assumption that full insurance is purchased. So we assume that there's no underinsurance. And the third one to call out is you might be wondering, why do we base this on gross household income as opposed to net or disposable household income? That just reflects that it's a data constraint that we face. We would ideally like to be dealing with disposable income. I'll also call out 2 other points from the part on the left-hand side of the slide here, is that while the red shaded area and obviously also the amber shaded area indicates high affordability stress, where it costs a significant proportion of a household's income to pay an insurance premium, what this chart also shows is that for the median household, so the 50th percentile household, where there's an equal number of households who have got premiums which are cheaper or more affordable, and an equal number of households who face premiums which are higher or more expensive, so that very middle household, we estimate that the cost of their home and contents insurance premium as at March 2024 was the equivalent of 1.4 weeks of their gross household income. So that suggests that insurance remains a workable solution, I would suggest, or the Institute suggests, for a significant proportion of the population. What this affordability work, though, allows us to do is really drill down into that upper tail, so the amber and the red area, for where we have concerns that insurance is becoming less and less accessible or is already inaccessible. If we could go to the next slide, please, Emma. So drilling down a bit further then as to why premiums have increased, or how much by, and what the drivers of that have been. So in the year to March 2024, what we show here on the slide in that bolded line on the left-hand side is what the overall increase in premiums has been at both the median level, so that very middle 50th percentile household. It was estimated as having increased by 9% in the year to March 2024. That is significantly less than what it increased by in the year to March 2023, shown in the lighter blue font below, where it was a 28% increase in the year to March 2023. We also show here what has been the experience or the estimate for the mean household, so the average concept. So the increase in the average household's premium was 13%. That is also significantly less than what we observed or estimated for the previous year, where that increase was 46%. So it is comforting that the rate of increase in premiums has significantly slowed compared with what it was, but it is obviously still well in excess of what incomes have grown by. So the affordability of insurance continues to deteriorate. So what's been driving that? The methodology that the Institute and this work is prepared by, I will acknowledge, by consultants from Finity Consulting, and Emma is an actuary in the Finity Consulting team. The key or how they construct this is shown in the remainder of this table here. So building cost inflation, we specifically do look at because that determines the sum insured component. That has not contributed very much at all in the year to March 2024, is our estimate. It only contributed 1 percentage point. What is notable, though, is that that is significantly less than what happened in the year to March 2023, where buildings cost inflation, and I'm sure many people have personal experiences with this, even just getting tradespeople to come out and do work. In the previous year, it contributed 14 percentage points, or half of the overall increase in premiums. So the key driver then in the year to March this year was that middle line, which is other insurance cost components. That includes expenses, profit margins, and net reinsurance costs. With the modelling capability that Finity has for this work, they do not have specific estimates for each of those components, but we can look to other sources to inform what has been contributing in each of those parts. So I will say that in terms of profit margin, the statistics which insurers report to the Australian Prudential Regulation Authority, so the regulatory body that oversights insurance, show that there have not been, or insurers have not been earning an underwriting profit on home and contents insurance in the past year, which then suggests that that profit margin has not been a key contributor to that 7%. More likely, where significant flow-through is coming from is the net reinsurance costs. So reinsurance is the insurance that insurance companies themselves purchase to manage the amount of risk which they are able to take on themselves. Reinsurance, it works on a multi-year cycle. It is a very global, sophisticated capital market. There is a flow-through process between reinsurance premium changes and insurers, and then how it goes through to the customer. Around the world, we're seeing the costs of climate change and natural disasters continue to escalate. So this is reflected in reinsurance costs, which in time flows through to the cost that insurers incur and which ultimately does get passed on to consumers. I think I've said an awful lot about that slide. Apologies, but I think it is important. If we could go to the next one, please, Emma. So then just looking at the distribution, geographic distribution of affordability pressure around Australia, the chart on the left-hand, or the graph, the map, I should say, on the left-hand side shows by local government area the concentration of home insurance affordability pressure by local government areas. So the more dark the red area on the map, the higher the proportion of households in those local government areas who are experiencing insurance premiums that cost more than 4 weeks of gross household income. So you can see that's particularly in Western Australia, especially the northern part, the whole of Northern Australia actually, as well as South Queensland and Upper New South Wales. On the right-hand side, we show by state the distribution of affordability-stressed households, the 4-week gross income point, compared with the households who have got premiums that do not cost as much as that. You can see Queensland obviously has got the highest proportion of households who are experiencing extreme affordability pressure. It's a very noticeable point there. Next slide, please, Emma. This graph splits it out even further, so by state, also by stressed versus non-stressed households, and the additional overlay on this compared with the previous slide is we're showing here then by specific natural perils how those individual natural perils are estimated to contribute to the insurance premium which we have observed as being quoted to households that fit into each of these categories. So the standout points here that you can see, the one that I would call out is if you look at the very right-hand side at Australia in the aggregate level, the key differentiator that we see between stressed and non-stressed households is that sort of brighter, darker blue bar, and that relates to flood and the cost that insurers charge, or the estimate for the cost that it is to protect households from flood. That is a key difference in what affordability stressed households are facing compared with non-stressed households. And the reason for this is that flood is a very localised risk and it is a very expensive risk. And this is clearly showing through in this chart. The other point that I would call out is, aside from flood, one other thing that we can see standing out is that as a differentiator is that other component, so that lighter green bar. You can see in some states in particular, so Western Australia is an obvious example, that there is a big difference in the composition of premiums by households to reflect those other costs that insurers are incurring and passing through. You can see specifically for Queensland what it shows there. Flood is also a significant component in Queensland, and I think I spoke about that in the previous slide. Maybe next one, please, Emma. So what we have included on this slide here is we acknowledge that not every household actually gets quoted the median premium, which is what our whole index, the slides that I have spoken to so far are presenting, that 50th percentile, that middle household. What do they face? What we show here is the range of premiums then that were observed in the market survey results to illustrate that there are a range of premiums in the market and how affordability pressure can change from those. So on the left-hand side, the bolder blue line in the middle shows the distribution of affordability pressure by median household. The light the lighter green line above it, shows what the distribution of affordability would look like if all households purchased a relatively expensive premium from what was in the market survey sample, the equivalent of the 75th percentile premium. So a relatively expensive premium. In contrast, the black line shows that if everybody purchased a relatively cheap premium, specifically the 25th percentile premium from that survey, it would show that extreme affordability pressure would be experienced by 11% of households. So it does show that there is a range of affordability pressure dependent on what consumers are actually purchasing in the market. Nonetheless, it's clear to say that there is a significant proportion of the population, at least I think we can confidently say 11%, for whom insurance is likely unaffordable, and that is a public policy concern for the Institute. On the right-hand side, the additional point to show here, as well as showing them by dollar amount for the premium rather than how many weeks gross household income it costs, is the full range of the premiums obtained through that survey result. That's shown by the grey shaded area. So that shows the absolute highest premium from the survey and the absolute lowest that came through. So you can see at the higher end of the risk distribution, as you move up the percentiles, there are some very large premium quotes being provided, which is informative to know, and yes, we assume that that would be unaffordable at that level. Next slide, please, Emma. So a second part of the report, which we put out this year, then did the extension to thinking about what does insurance affordability pressure mean for mortgages, because we know that there are wider financial system risks. Now, I won't go through everything on these slides. I'll move through more quickly. But as I think most people would, or a number of people would be familiar with, it is standard practice that when a person takes out a mortgage, that it is a condition of the lender that the home has got a home buildings and contents insurance policy in place at the time of that loan. That is to protect the risk which the lender, the bank or a non-bank, is exposed to, so that they are only taking on credit risk. They are not also taking on the risk of natural disasters, which might be uninsured for. So what we did in this piece of work, or what Emma's colleagues at Finity did, is they developed a second data set, and they matched it up to that data set that I've just spoken about to understand the households in Australia who are facing extreme affordability pressure for insurance, and so whom we assume do not purchase insurance then. We wanted to find the overlap between that group of households and the group of households for whom where the home loans are who also have home loans in those areas which are experiencing greatest insurance affordability pressures. So the specific estimates that came through were that there were 180,000 mortgages or home loans in place, and that it represents $57 billion of lending, which is approximately 3% of total home loan assets on issue at that point in March. I will stress, so that's the equivalent of what's shown in the second bottom row of the table on this slide under the extreme pressure for insurance affordability. I will make clear that we are not saying this is a $57 billion credit risk to the banking system at all. We are just trying to get a size on the potential issues which would need to be worked through should banks and insurers and consumers themselves need to pay more attention to the importance of having insurance in place at the time that mortgages are in place, because it is a natural protection to ensuring overall financial system stability. Next slide, please, Emma. So in terms of that distribution of those 3% of home loans around Australia, or the $57 billion of loans, this map shows where the concentration or how they are distributed around Australia. Again, the darker the red, the more heavily concentrated the risk is. So you can see in the upper coastal New South Wales area, that has got the highest proportion of what we have described as home loans at risk. So where insurance has become experienced extreme affordability pressure, and that there are a number of households with mortgages in that area. Now, the obvious outworking is that with climate change, we anticipate that proportion will only go in one direction, upwards. Next slide, please, Emma. So the Actuaries Institute, we always like to offer solutions, hope, ways to work forward, not just present problems. And a key part of the solution is resilience lending, which is part of sustainable finance. I'll just talk left to right from the columns in this slide. So what does resilience lending mean? For households, what it means is that their lender will extend credit to them, assuming that they meet responsible lending obligations, to make improvements to their home that improve the resilience of the structure. So whether that's raising the floor height, improving the roofs, tightening them, or measures like that. So that means that households who can afford to do such improvements and want to do such improvements, this is a way which they can take control over the situation in which they're in. Moving across the chart, for banks, what it means is that it also helps banks reduce the credit risk which they are exposed to, because it is a higher quality asset. It's obviously a new type of lending activity which they can engage in, as there is more appetite for wholesale investors who fund banks. They will be increasingly looking to take up green loans, and resilience lending would contribute to green loans. For insurers, this is an obvious way that insurers can help their customers manage the risk, which is also an objective of insurers themselves. They want to make a constructive contribution to society. What needs to happen, though, is that there is an objective risk measurement process that all the parties here can agree is a fair recognition of the risk, so that it can be rewarded in fair premium reductions, even improve the cost of lending that banks could extend. Investors, as I've already explained, they've got an interest in taking up green loans. And what it means for government then is that government can very much focus its efforts, its financial efforts and its other resources to help households for whom resilience lending themselves is not an option. So I think we can all agree that is something that we should be supporting.
Thank you, Vanessa, and I will now take us through the Australian Actuaries Climate Index. So the Climate Index is a way of providing a measure of climate change for an insurance context. So obviously there are a lot of different organisations in Australia and internationally that measure climate change in one sense or another. But a lot of those focus on averages, and in an insurance context, we're most interested in the extremes because that is where the damage occurs. And so the way that we do that is we quantify whether the frequency of extreme weather conditions has changed over time. And this is done by comparing observations to a base period, which in this case is 1981 to 2010, and looking at whether we see observations that exceed the 99th percentile of that base period on a more frequent basis than we did back then. So if nothing changes, if the climate is stable, then we would expect that on average we would see exceedances over that 99th percentile about 1% of the time. And if that number increases over time, then we can see that the frequency of extreme weather is increasing. And we do this for a number of different metrics, which I'll take you through in a minute, and for different regions across Australia. So These are the metrics that we cover in the climate index. We look at extreme high temperature and extreme low temperature, rainfall and consecutive dry days, extreme wind, and maximum sea level. And in terms of the regions that we cover, we use these climatologically similar regions in Australia, so they don't correspond with states or any kind of administrative boundary exactly. They're based on the climate of the region. And you can see that we've got a couple of different clusters that cover Queensland and in particular East Coast North and the wet tropics. And so for each of these clusters, we have an index, and we also have one for Australia as a whole. The overall composite index looks like this, and what this basically tells you is if we're seeing a red bar for a particular season, that means that that season was more extreme than the base period, whereas a blue bar means it was less extreme. Now, this composite index is a combination of 3 of those metrics that I discussed earlier. So we take extreme high temperature, extreme rainfall, and maximum sea level, and we combine those to create the composite index. We don't include all of the weather metrics because if you include multiple temperature measures, for example, you're sort of overweighting towards temperature and underweighting towards some of the other weather metrics. And the wind metric has some stations don't provide a long enough time period for us to be able to include that in the overall index. And so what you can see is that over time we do see an increase in the frequency of extreme weather in Australia. The black line that you can see is the 5-year rolling average, so that sort of smooths out some of the individual observations and shows that generally speaking there is an increasing trend over time. Now, if we look at more specifically the recent results that we've seen in Queensland, what we can see is that the most recent season, which was the winter of 2024, was a fairly extreme season in this part of the country. So we had an observation that was positive and quite significantly elevated. It was not one of the most extreme seasons that we've ever seen. So we did see an even higher frequency in a couple of different seasons, including back in 2021 and back in what is it, 2012. But it was a fairly extreme season. And what that was driven by is elevated temperatures. And I'm sure that this is something that many of you remember experiencing on the ground. I remember it being very warm in Sydney, so I can only imagine that it was even more warm in Queensland, including some days in August where temperatures hit 40 degrees, which is quite extreme. And if we look at the extreme high temperature index, specifically in the winter of 2024, this map on the right shows that most of the country was experiencing a heat wave, and that was most pronounced in Queensland, especially up at the top there. Now, the metrics that we include in the index were chosen because they link to damages to either the economy or to people. So they represent some kind of increased risk in that sense. And so I wanted to briefly touch on the impacts of high temperature in particular. So this is a phenomenon that can have significant impacts on both people and the economy. And there's often interactions or cascades that may not be apparent immediately, but can cause very significant harm. So for example, increased temperatures can lead to, for example, increased propagation of insects if the nighttime temperatures do not go low enough to kill those insects in the winter. That means that they propagate more. And then you've sort of got that combined with the increased natural disasters, which will often lead to something like a bushfire. So you've got these insects that are often damaging the timber forests that are used to supply those building materials that the insurance industry relies on to rebuild after a disaster, plus the fact that those disasters are more likely to happen. And that can often lead to higher insurance premiums through that building inflation, which Vanessa has also mentioned, and those increased natural disasters. So there's sort of a couple of different pathways that increased temperature can have negative impacts in that sense. Then if we think about healthcare, heat waves are a very significant risk, especially to the elderly, to young people, so very young babies, and to pregnant women. And that interacts with other societal factors such as an aging population and increases in chronic disease, and that causes pressure on healthcare systems. So these are issues that have significant impacts on people and on the economy, and we see that as being relevant to the insurance industry, both general insurance, so the home insurance that you purchase to protect your property, but also other parts of the insurance system, such as healthcare and private health insurance. Now, obviously, the climate index sort of has certain things it's good at and some things it's not so good at. So the climate index does a good job of tracking the influence of climate change on extreme weather by region. So it provides us with a metric of a way of measuring that. And it confirms how climate drivers are affecting Australian weather on the ground. But it also has a couple of things that it doesn't do so well. So obviously this is looking at weather, so it doesn't look at insurance risk directly, although we do believe that there is some relationship between the two. It's not predictive, so we're not able to say what will happen in the future. And it is a difficult metric to understand, which is something becomes clear to me every time I present on it. It's not an intuitive metric, and we do sometimes struggle to explain exactly how this works. Now, we're always looking at ways of improving things, and at this point in time, we're investigating a couple of different ways of improving the climate index, one of which is the use of reanalysis data, which I'm sure many of you are familiar with. Some of the main advantages are that it gives us data at a more geographically granular level than the weather stations, which is obviously an important input into this and determines sort of the quality of the index as a whole. So we're looking at potentially moving to reanalysis data because it would allow us to get that better geographical coverage. And we're also interested in potentially adding other metrics such as soil moisture, because we believe that they might be better proxies for risk and allow us to understand that in a better way. So that's something to keep an eye out for in future improvements as we move forward.
Yes, well, Vanessa and Emma, that was a very sobering presentation, because we appreciate how you come from the world of very disciplined statistics and forecasting that being an actuary is all about. So thank you so much. Look, I've got a couple of things to ask, and I've asked people to send in some questions too, because I'm sure there'll be some. I was interested on one of the charts that, and you mentioned bushfires at the end, but bushfires were down there with earthquakes in terms of the risk, very small. Do we kind of overemphasize the risk of bushfires and underestimate that of storm and flood?
Would you like me to take this one, Vanessa? Or
okay, yes.
So I think the way that I think about it is bushfire is a risk that affects certain properties that are, on the edge of potentially a forest or exposed to some flammable vegetation. But in terms of very large events that affect a very widespread area, we do see that storms, for example, there's some storm risk across all of Australia. So you're going to see costs coming in from all parts of Australia, whereas bushfire is much more localized, and that can play out in terms of the averages. But obviously for an individual property or even for a particular town or city, it can be, you can have very significant bushfires. That's how I would think about that, but interested to hear what you think as well, Vanessa.
Thank you, Emma. From the home insurance affordability work, yes, it is very much described as bushfire impacts. I think sort of the edges of cities in general, the capital cities, but not the heart of the cities so much. Whereas, yes, storm does, cyclone obviously across the top of Australia, and yes, they're wide area perils, so there are many more households than that can be affected, which is why they are more costly in what I think you observed, Chris, then.
Yeah. Now, you've shown us how the stress of paying for home insurance really falls very strongly on 15% of households. But those households, I think your research has also shown, those are the most vulnerable households. Those are the people with the lowest income, single person households, most at risk, least able to invest at all in resilience. What are the sort of policy fixes for this? And I know that Affinity Consulting do a lot of work with the federal government. How seriously are governments taking this? And I know there are various suggestions, and we've had a insurance pool in terms of cyclones in North Queensland. But what's actually happening?
So maybe to begin with, then the reinsurance pool, that was an announcement, I think it was perhaps, whether it was 2019, 2020, it's now almost in full implementation. I think by December this year, every insurer does need to be in that reinsurance pool. What the effect of it is instead of the general insurers that people buy their home and contents from, instead of them reinsuring those portfolios with the reinsurers that I explained in the charts, the government is stepping in to reinsure that part of their portfolio. And the idea there is it reduces the costs of the insurers for that protection, and it is meant to be passed straight through to consumers. The ACCC, the Australian Competition and Consumer Commission, has been charged with, I think it's 5 years worth of price monitoring to assist with that. So that's how they're addressing cyclone risk. There are numerous parliamentary inquiries about should there be more perils covered by a reinsurance pool, flood being the obvious one that has been called out from time to time. And then there are all sorts of other questions. So even not reinsurance pool, but what other solutions? State taxes and charges are frequently called out. You may recall seeing from that bar graph, they contribute materially to the end premium, which consumers pay.
Stamp duty in particular is a bugbear.
Exactly. Yes, a stamp duty, and in New South Wales, it's also the emergency services levy. The particularly inequitable aspect of those taxes and charges is the higher your premium is, the more you pay in insurance taxes and charges. So the people who are already facing the most risk and who live and I think most of us would realise a lot of Australia's most vulnerable housing stock is in the more peril-prone areas. It reflects in the insurance premiums paid, and then state taxes and charges come in on top of that. So it's the most vulnerable people facing the highest premiums who also pay then the highest funding for those. So, I mean, there's a range of things being talked about. There's numerous inquiries in hand. And there was, of course, the House of Representatives inquiry that reported, perhaps it's 2-3 weeks ago now, more than 400 pages worth of commentary and recommendations with the government to consider.
Look, I know it goes on, and I know that there are people listening who've been affected by floods in Queensland or cyclones. So do please send in your questions. Don't be, I know there's an enormous amount of detail that we have to absorb, but there are some other more basic questions about this, and I suppose one of them is that who, you know, if you can't get in, I mean, you said affordability and accessibility are the same, but if people can't, you know, there's also that some insurers will not cover you because you're in a flood-prone area, you know, and the premium might be ridiculous. Now, us geographers love maps. Why on earth are we still building and developing on flood-prone places? Is the data not good enough? Is the government response, local or otherwise, not good enough? I mean, it seems extraordinary in this day and age.
I think we absolutely agree with you. It does seem extraordinary. I think at New South Wales, where both Emma and I are based, there is the Western Sydney Nepean River region. It is flood prone. There continue to be housing development there. I think what it reflects is we also have a housing affordability crisis and a shortage of homes. So it is a really complex problem to work through. I think the people on this call are two areas of science, though, which would suggest other town planning solutions, build in other areas. But then that opens up the debate about, is density the solution to make it more affordable? And these are not simple issues to work through.
Right. We have been sent in a question. I noticed Elizabeth Handley's raised hand, but Elizabeth, can you just send us in the question, just write it in the chat. That's going to be a little bit more efficient at first. So we did get one sent in advance. Someone saying their insurance went up double this year, even though they hadn't claimed for as long as they remember. Rang around and couldn't do any better. What do you advise people? I mean, you're consumers too. I thought it was interesting that there was such a big gap between the highest quote, you know, the 75%, and the lowest quote, which just suggests if you shop around and ask around, there is a significant difference.
Precisely. I'll have one suggestion, and Emma, maybe you have more. It sounds like you're a very informed consumer, so I hope you've also considered looking at your excess. That is something that I think most people would suggest. So what level it's set at. The higher you can set your excess, the lower the premium will become. You obviously need to make decisions about what is the risk, though, that you could afford to wear yourself should an event occur. I feel for you.
Yeah.
Yeah, I guess the only other thing I might add to that is that there is an organisation in Australia called the Resilient Building Council, which is looking at supporting people in making their homes more resilient. And insurers have come on board and agreed to offer or to reprice the risk to reflect any improvements that people make based on the information they get from the Resilient Building Council about how to do that. So basically, the RBC, assesses your home and provides you with advice on how to make your home more resilient to bushfires or some other peril. And then if you go away and make those improvements, there are insurers that will reprice your premium based on that. And that can, in some cases, make a significant difference. So that would be one thing to look into as well.
Got a question from Elizabeth Handley. Has the insurance industry thought about developer insurance if you or they build in riskier areas? So it's kind of shifting the burden onto the developer paying the insurance as opposed to the consumer.
The Institute has not done any, it's an interesting question. And the Institute hasn't done any work on that. So this is a very top of mind reaction. What occurs to me, though, is a developer is a relatively short term, as soon as they've offloaded it from, and excuse the crude expression, please, but from their books, that it is in a homeowner's hands. It's the homeowner and any insurer or lender who is then wearing the risk. But it's an interesting suggestion that could be considered as part of sort of the original question of how do we improve Australia's housing situation. That would focus minds.
Yes. And Elizabeth has followed up to say her insurer's been very unresponsive dealing with a claim. Is there any way to make insurers more responsive to consumers? I mean, there is a ombudsman, insurance, all these kind of things, but ultimately that's the thing about insurance. People buy on what the premium costs without necessarily knowing what the problems of claiming are going to be relative to each other. And I would just say that household insurance, whereas car insurance, you can go to comparators, the insurers have avoided household insurance being subject to intermediaries and comparison sites because they saw what happened in the UK when something that really gutted their profitability. I think it would make it much easier for people to shop around than the current system. But anyway.
I will add, in terms of claims experience, it is very much on parliamentarians' radar. That is exactly what the House of Representatives report was about, the insurer's response to the 2022 floods. So it's absolutely being very closely scrutinised. There is also the General Insurance Code of Conduct, and ultimately, yes, the Ombudsman.
Okay, I would just invite any last questions from the floor because we're just coming to the last 5 minutes. Yeah, we've got one from Chris Walker. The Queensland government adopted a 0.8 metre sea level rise by 2100 projection several years ago, but other states have more recently adopted sea level rise projections of about 1 metre. Should the insurance industry be calling out obvious discrepancies in government projections of climate risk? I know that you're not the insurance industry and you are the actuaries, but I mean, this is part of the problem, you know, that the various predictions, there's no harmonization in government predictions about this.
So what I would say, but Emma, I think you have experience in this, so please jump in afterwards, is yes, it is incredibly complex to do climate change projections, and what actuaries assist with more is scenarios, because it's very hard to know how things will actually play out. It's dependent on global responses. So, for example, what comes out of the COP discussions, which are currently underway, and those ongoing discussions, how societies choose to adapt. There is the Australian National Adaptation Plan as part of that. And then there's the whole scientific understanding about tipping points, irreversible changes. There's a lot that we know we don't know. So high uncertainty. But I think most people would, yes, support greater consistency to at least be comparing apples with apples.
We've talked about resilience and mitigation, but has anyone actually put a price on that? We know that the cost of the extreme weather events is, you know, billions and set to be massive sum. But what is the cost of hardening our homes to make them more resilient?
I don't. Oh, Emma, do you know that one?
I don't know the number off the top of my head, but it will obviously be quite significant. I do think there's also some opportunities for the financial system in that space, though, in the sense that if you're able to lend money to, as a bank, for example, if you're able to lend money to your customers to enable them to make their home more resilient, that will kind of benefit both parties as well as the society as a whole. And that is something that we've seen some banks begin to introduce. So Westpac, I believe, has a resilience lending of up to $50,000 that they have started to do, and the interest rates on that are better than what they offer for home loans more generally. And that will, you know, enable some customers to make their homes more resilient, which will, you know, reduce their insurance premiums. And it also makes the collateral that's associated with the mortgage more secure, so less exposed to climate risk, which is what Vanessa was discussing earlier in the home loans section of that report. So I think there are obviously significant costs, but there are some opportunities as well.
There are also, I would add, even more significant costs from inaction and continuing with business as usual. I can't recall what those numbers are off the top of my head, but they are significantly higher. So I guess it's a problem that involves cost no matter what, with high uncertainty.
Okay, I've got our last question, another follow-up from Elizabeth Hanley. Now, you've identified regions that are at risk, but where is the good public information available on identified risks? And I take that to mean on a plot by plot basis or a street. And that's been one of the problems, that it's very hard. The insurance company, in some ways, know more than the consumer in terms of the risk that they assess on any particular home site. What are we supposed to do?
I would recommend looking at council maps. Now, there is obviously variation in the quality and availability of those across the country. But that is what I would suggest people do if they want to understand what's going on for their particular property. And obviously, as a group, you're probably better positioned to understand how to read a map than most consumers, and where that data might come from. So in that sense, you do have an advantage. But that would always be my first port of call, would be to look at the local council maps and see what's going on there.
Exactly. Okay, well, look, we're very near closing time. I'll just ask you both for a final thought. What keeps you up at night? I mean, you're delving so much into this climate risk and extreme, but what does anything keep you up at night? What is disturbing about this? Or do you hold some hope that actually the COP process, whatever, or the financial or the insurance industry or the government are actually going to be able to get stuff together in time?
I'm actually in a phase of hope, Chris. Perhaps I'm naive, but I would like to think that humanity is intelligent enough to save ourselves from the abundance of scientific evidence that points to this being potentially an existential crisis for certainly certain countries or areas, that surely we have our wits about us to solve this. I hope it's sooner rather than later, so it's more orderly than disorderly.
Yeah. And Emma, because I know as actuaries, you have cold-blooded analysis of so much data, but of course this does reach very much into our own lives.
It does, yes. And I think one of the concerning parts of this is that obviously it's not a problem that affects people equally, as we've discussed in the affordability paper. And I think that often, the people who are sort of discussing this are in a position where they do have different options. But that is not always the case for everyone. And I think that's really important to remember as we try and find solutions.
Well, that's a great place to end it, although it doesn't, we know it's going to go on, because I know that in another 2 years, you're going to have another one of these reports, and it's going to say there's 20% of households that are under this great pressure. So I just wonder where it'll all end. But look, we'll leave that to the future. I'd just like to say big thank you for Vanessa Beenders for being with us, and of course Emma Vitz, and sharing that. You can actually go to the Actuaries Institute website and download this report, and it'll have all the detail and appendices, even the most data-driven of our members could possibly want. And there's all sorts of other interesting things that actuaries do that you might not know about, which I know that Vanessa would love to do. Big thanks to John and the RGSQ team, and I'd wish you all good night. The storm has passed in Brisbane for the time being, but we might have another extreme weather event before the week's out, who knows, but I wish you all well, and good night, and thank you.
Thank you, everyone.
Thank you.